There's a strategy in real estate investing that's responsible for creating more millionaires than almost any other. It's a system for buying properties, fixing them up, and pulling your initial investment back out so you can use it again and again. It's called the BRRR method, which stands for buy, rehab, rent, refinance, and repeat. This isn't a quick overview. This is a deep dive 45-minute workshop on how to execute the entire BRRR strategy right here in Michigan, with a heavy focus on the most critical piece of the puzzle, the financing. If you're not interested in value-add real estate or building a long-term rental portfolio, this probably isn't for you. But if you want to learn how to recycle your capital and scale faster than you ever thought possible, stick around. I'm Trevor Sines with Michigan Mortgage Solutions, and today we're building your BRRR machine from the ground up. Let's start with a high-level view of how the BRRR method actually works. The first step is buy. This is where the money is made. We're not buying turnkey homes. We're targeting distressed or undervalued properties that need work and can be purchased below market value. Next is rehab. This is where you force appreciation. Through renovations like kitchens, bathrooms, flooring, and mechanicals, you increase the value of the property beyond what you paid for it. Then comes rent. Once the rehab is complete, you place a quality tenant in the property at market rent. This stabilizes the asset and turns it into predictable income. After that is refinance. This is the most important step. You replace your short-term financing with a long-term loan based on the property's new after-repair value, not your original purchase price. This is how you pull your capital back out. Finally, repeat. You take that capital and deploy it into the next deal, allowing you to scale without constantly injecting new cash. The entire strategy hinges on the refinance. If you can't get your money back out, the machine stops. That's why having a financing partner who understands both the acquisition and the refinance is non-negotiable. Now let's talk about how you fund the buy and rehab phase. You can't use a traditional mortgage on a distressed property that needs major work. For that phase, you need short-term, asset-based financing designed specifically for value-add projects. At Michigan Mortgage Solutions, we offer two primary tools for this stage. The first is our fix and flip loan. This is our flagship product for BRRR investors. It's a short-term loan that covers both the purchase and the rehab costs. It's built for speed and leverage, allowing you to get into deals with less cash out of pocket. These loans feature interest-only payments, which keeps holding costs lower while the renovation is underway. The second option is our bridge loan. A bridge loan is ideal when speed or flexibility is the priority. It works well for auction purchases, quick closings, or situations where you need to temporarily access equity to secure a new deal before long-term financing is in place. Choosing between a fix and flip loan and a bridge loan depends on the specifics of the deal. Most standard BRRR projects are a great fit for the fix and flip loan, while bridge loans are better for more unique or time-sensitive scenarios. We help our clients model both options so they can choose the most profitable path. Now, let's move into the most critical step of the entire BRRR strategy, the refinance. At this point, the rehab is complete and the property is worth significantly more. Let's say the new appraisal comes in at $250,000. That's the after-repair value. You then refinance out of the short-term fix and flip or bridge loan and into a long-term rental loan through Michigan Mortgage Solutions. This is a 30-year loan designed specifically for buy-and-hold investors. Our rental loan is a DSCR, or Debt Service Coverage Ratio loan. That means we qualify the loan based on the property's income, not your personal W-2s or tax returns. If the rent supports the mortgage payment, you can qualify. This is what allows investors to scale efficiently. We will typically lend up to 75% of the new appraised value. 75% of $250,000 is $187,500. That new loan pays off the original acquisition financing. If your total investment is below that amount, you walk away from the refinance with your original capital fully returned and ready for the next deal. That's the BRRR machine working exactly as designed. Let me walk you through a real Michigan example. One of our clients purchased a distressed home in Redford for $80,000 and completed a $60,000 renovation. We funded the majority of that project using our fix and flip loan. After a 4-month rehab, the property rented for $1,800 per month. The property then appraised for $220,000. We refinanced them into a 30-year fixed-rate rental DSCR loan at 75% of the new value, resulting in a $165,000 loan. That refinance paid off the fix and flip loan and returned all of their original cash investment. They now own a stabilized, cash-flowing rental with none of their own money left in the deal, and they use the capital to repeat the process. The BRRR strategy is entirely dependent on having a financing partner who understands the full life cycle of the deal. At Michigan Mortgage Solutions, we are that partner. We provide the short-term fix and flip financing and the long-term rental DSCR loans, all under one roof. If you're an active investor looking to scale with the BRRR method, the financing is the key. We invite you to schedule a free property consultation with our team. Call us at 248-963-1894 or visit MichiganMortgageSolutions.com to plan your next BRRR deal. I'm Trevor Sines with Michigan Mortgage Solutions. Let's build your portfolio together.